But I think that wall is about to hit, right? We're looking at about 12,000 boomers retiring daily in this country. And if you're surprised by the tightness in the labor market, the inflation driven by wage inflation, that is a big driver for that. And so inflation is almost the other side of the coin when you think about aging demographics, right? It means people with money are now not working and not saving, but spending money, right? So that's almost, from deflationary where we work and save money to very inflationary when we don't work and we're spending that money. So I think for anyone to think that inflation is a short-term thing, it's mostly a government printing money thing. No, there's a big structural reason. Boomers retiring, aging demographics in this country, but more globally in all of the advanced economies.
Discussions in this show should not be construed as specific recommendations or investment advice. Always consult your investment professional before making important investment decisions. Securities offered through registered representatives of Cambridge Investment Research, a broker-dealer member FINRA SIPC. Advisory services through Cambridge Investment Research, Inc., a registered investment advisor. Cambridge and Houston First Financial Group are not affiliated.
Welcome to Money Matters with Chris Hensley, where we spotlight financial literacy issues in the Houston community and beyond. And now your host, Chris Hensley.
Welcome to Money Matters, the podcast where we decode the future of finance for you. Joining us today is Jason Hsu, a visionary leader whose work at the helm of Reliant Global Advisors has redefined global investment paradigms. Founder, chairman, and CIO of Reliant Global Advisor, Jason brings a wealth of experience from the forefront of quantitative and quantamental investment strategies. With accolades like the Graham and Dodd Scroll Awards and the William F. Sharpe Awards under his belt, Jason's insights on global demographic shifts impact your investment choices are indispensable. Today, we'll explore how these profound changes are reshaping economies worldwide and what that means for your long-term security and prosperity. Get ready to expand your perspective with one of the leading minds in finance as we navigate the complexities of an evolving world. Jason, thank you for joining this show. Welcome.
Chris, thank you for having me.
I'm super excited to have you on the show. This is another, for listeners who've been listening, I went to the Future Proof event in Colorado, recently. And I want to say I've had 3 or 4 people that we met from good old fashioned networking. You hosted one of the most fun events there at Future Proof, and that was the ziplining event. So, we found ourselves on a little minivan on the way up the side of a mountain, getting up to the ziplining there. So that's how we met there. So I'm familiar with you, but for listeners who may not be as familiar, could you share something about yourself, maybe outside of the bio, so we can get to know you a little bit better?
Yeah. So I'm also a business school professor. And in fact, teaching is probably my first love and my true love. So in some ways, the part about my job I enjoy the most is sort of sharing what I research in a way that actually is useful, understandable, and consumable for prospects and clients of ours. So thank you for giving this opportunity to do what I really love, which is to explain my research, hopefully in a way that your audience will find useful.
Yeah, I love it. And I know at the end, we'll make sure that listeners get a way to get access to your newsletters and everything. And one of the newsletters that you wrote recently had to do with changing demographics. And I thought that would be a good one for our listeners. So let's just dive right into it. How do global demographic shifts, particular aging populations in developed markets, influence investment strategies for pre-retirees?
Yeah. So the one thing that we've talked about forever and a day is boomers are retiring, right? But that impact is so slow, you kind of, been able to shrug it off and really it hasn't impacted your portfolio. But I think that wall is about to hit, right? We're looking at about 12,000 boomers retiring daily in this country. And if you're surprised by the tightness in the labor market, the inflation driven by wage inflation, that is a big driver for that. And so inflation is almost the other side of the coin when you think about aging demographics, right? It means people with money are now not working and not saving, but spending money, right? So that's almost, from deflationary where we work and save money to very inflationary when we don't work and we're spending that money. So I think for anyone to think that inflation is a short-term thing, it's mostly a government printing money thing. No, there's a big structural reason. boomers retiring, aging demographics in this country, but more globally in all of the advanced economies.
We as advisors, we hear that number that, 12,000 boomers are retiring daily. And we've heard that for the last 10 years. We almost get desensitized to it. But I like the way that you're sharing with listeners that, these are people that were working that are no longer working and no longer spending as much, and how that's tied into inflation. That's huge. Let's talk about, you're one of how I know emerging markets, that's what you're known for. Given the changing dynamics between developed and emerging market, what opportunities should pre-retirees consider in emerging markets?
Right. So I've just stated kind of the problem, which is like, if, we Americans are going to retire and want to spend the wealth we have accumulated, right? Well, someone's got to do the work, right? Otherwise, you just have inflation, everything gets more expensive, and our wealth is meaningless, right? So to solve that problem, what we need younger population. And generally, we're going to find them in emerging economies who are in manufacturing. So they ship their labor to us in terms of low cost goods so we can continue to consume them at reasonable prices. So they're almost the other end of the coin, right? The other side. So they're the solution. And as we age, right, we're going to depend on that labor force, a younger pool of cheap labor who provide, manufactured goods to us. And that will also gradually mean they're going to get better terms of trade, right? I mean, historically, they sold cheap goods. We capture most of the value. I think we're going to see them asking for a pay raise, much like the labor in the U.S. is asking for a pay raise. Now they see the opportunity. Same thing in emerging markets, right? And so we're going to see better margin, better profitability, growth that's both from exporting, but now exporting at higher prices from EM. So that's really the opportunity for EM. And it's a way for you to hedge the coming inflationary pressure, right? It's you buy, countries that can export their deflation to us and solve our inflationary problem. So, if you're buying gold as a way to hedge inflation, I think there's something else you need to buy, which is the low cost manufacturing capability, that human capital in emerging markets as a way to hedge this long-term structural inflationary problem driven by our demographics.
I love it. We've heard the emerging markets story many times, but I really like to frame it the way that you just did with age. The idea of the aging boomers in the U.S., but then you've got a younger population when we look at manufacturing, exporting, but at higher prices, right? So really being able to hedge that. That is an interesting way to look at it. I think that's a really good thing to point out. Let's talk about, and we'll kind of pivot a little bit here and talk about currency reevaluation. Can you discuss the potential impact of currency reevaluation in emerging markets on retirement portfolios?
Yep, absolutely. Right. I think there's a big concern in this country, and rightfully so, that the dollar is going to gradually weaken as we simply have to spend more to keep our government functioning. And so you've kind of seen that, in terms of gold price, in terms of real estate prices, the hard assets have clearly shown that the dollar sort of weakens. But, what are you going to do? What currency would you want to hold? Do you want to hold the euro? Do you want to, hold the British pounds? No, they're weakening at the same speed, probably faster than the U.S. because they face some of our same problems. They're aging even faster, right? They don't even have the kind of immigration we have to we use immigration as a way to age slower. So you really got to look to currencies which are going to appreciate against us, because what's backing those currencies are the appreciating harder assets. And this is where I like the EM currency. And this is not a hypothesis, right? You just look at the emerging market countries that export, right? It started with Japan, right? It used to be 400 yen to the dollar, and then it got to 200, and then got to 100 yen to the dollar at its peak. You saw the same thing with Korean won, Taiwanese dollars, later on with the renminbi, right? Any Asian export economy, generally they're the dominant economy in the EM basket. As they export more, you see that currency appreciate as their human capital becomes more valuable, as they can extract higher prices, as they do higher quality work. And so again, I think the emerging market opportunities is not only are they going to charge higher prices, they're also going to have a stronger currency because they simply will have more stuff backing their currency than we do.
I love it. You've probably heard this story from many advisors that you've talked to, where we know that we should have a non geographically biased global portfolio. Yet this story with the being skewed towards U.S. domestic for a long time. That's been a thing. But when you mention things like currency reevaluation, and it's not a hypothesis, we can see it. That the hairs on the back of my neck stand up. It makes me say, if you're wanting to have non-correlated assets and you want to have a truly diverse portfolio, there's an argument for that for sure. So I went off on a little soapbox here for a second, but let me get back to inflation concerns, right? Because that's a huge thing. How might inflationary pressures from an aging global workforce affect fixed income investments for retirees?
Okay, so this is where there's a famous book done by two Harvard professors, and it's called Financial Repression. So what that says is, developed world governments are literally near bankruptcy, right? I mean, the only way they finance themselves is they keep interest rate really low, so their debt servicing is really low because they have no intention of paying back that debt, right? There's just no ability, right? They would have to tax so much that you would get a revolution. And so interest rate is going to be low, near zero, really. And you've seen that with Japan, you've seen that with the Eurozone, and the US tried it for a short while. And so we're going to get back to there. And so if you are a retiree and you say, hey, look, I'm going to live off of my retirement income. I built up a $2 million, $3 million portfolio. Hey, if I can have 5% interest rate, right? Plus my retirement benefit, I could have an easy life. No, because that interest income is going to get back close to abysmally poor very soon. The minute we can afford to rate cut again. So I would say, as a retiree, your job has been made very difficult, right? You can't really de-risk into just a fixed income portfolio because fixed income is not going to pay you. So that means, as a retiree, you're forced, and you will have to take equity risk within your portfolio. You just have to think about, well, how do I take the equity risk in the portfolio so that it's going to offset the inflation risk I face, right? So I'm going to go back to your question, Chris. What does that mean for the retirees fixed income portfolio? You're not going to want a 60-40. You're not going to, want to hold an income portfolio based off of just sitting on T-bills. That isn't going to work well enough for you. Tactically, I think we got some rate cut coming. So not recommending that you get out of long dated fixed income, get out duration just yet. But I would say the rate cut is going to give you a big one-time boom in terms of fixed income revaluation. But once rates are low again, you're going to have to move off of that because you're not going to get enough income out of fixed income. And it's time to be really intelligent about how to selectively redeploy that bucket to get the inflation hedge.
I love it. So this is a conversation we have with our clients that got rich in the 80s, right? And you could take a bucket of money and put it in bonds and you were okay, right? That changed over the course of the last, X number of years. We may have gotten a little bit spoiled as we've seen the recent run up and stable value fixed cash equivalents, CDs, that kind of stuff. But you're giving us a really good reminder that there's only one place it can go. And we know we should have this on our radar as retirees to not get, with these recent things that we've seen, don't get too spoiled with it because it will change.
It will change.
Let's talk about trade dynamics, because that's another area that you've talked a lot about. With emerging market gaining leverage over older trading partners, how can pre-retirees adjust their investment portfolios to benefit from this shift?
Yeah. So, a lot of people, when you say, you should look at emerging markets, right? They said, I heard that story for the last 10 years. It hasn't worked there, right? And I don't expect it to change. So let me kind of walk people through why it didn't work and why it's going to change, right? Because this is not the history is going to rhyme kind of situation. So historically, when you look at EM, right? EM has grown historically, right? EM has been productive. It sells a lot of stuff, right? Both in terms of raw resources and manufactured goods, right? EM has been incredibly productive for the developed markets, right? They're a big part of why we have such a wonderful standard of living. So it's not for the lack of growth in those markets. What's really plagued them is they had no pricing power, right? So to give you some examples. So Chris, you probably didn't know, like for every $100 million worth of raw resources that we take out of Africa, guess how much they get to keep? 10,000. Right?
Really?
Like that's such a abysmally poor
Yeah.
like split, right? Like it's not 1 basis point. It's like tiny fraction 1 basis
That's
point.
a
Like even in
small.
yes. If you're an advisor, right, you sure hope you're not taking that kind of fee, right? Because that doesn't
Right.
generate any profit. You would work so hard to keep so little, right? Another example, right? Like iPhone, right? Like a low grade, cheapest iPhone goes for $800, right? The guy who makes the iPhone, Foxconn, one of the biggest contract manufacturers in Asia, right? They make $8 out of getting all the material, put it together, and ship it to Cupertino, right? And
Wow.
in that case, Apple makes what? $300, right? You look at Amazon, right? Like China exports 3.3 trillion bucks worth of stuff, mostly consumed in the US. The exporters in China make 60 billion out of the 3.3 trillion they export. The Amazon type platform takes in 300 billion, right? And it's not, EM isn't productive. They create a lot of value. Just a lot of value gets captured by American consumers and American platforms who sell to the consumers. And so the theory for EM is not about EM's going to be more productive, right? The theory for EM is finally going to be able to negotiate more pay rates, right? EM is finally going to say, this is not okay. I can't put up with this. And they're able to do that, not because, they're just going to get angry and negotiate. That doesn't work, right? It's the ship and supply and demand, right? It used to be there are too many poor EM countries that are willing to do dirt cheap work and compete to price undercut each other. And DM, right? Basically had all the leverage, bargaining power. As DM gets older and older, its bargaining power decreases. And as EM gets wealthier and wealthier, right? Like now you're seeing China saying, I don't want to make t-shirts and jeans anymore, right? I don't want to make sneakers. Like that's got to go to Vietnam. That's got to go to Thailand, right? We don't make enough margin to pay our workers that way. Like we can make, high-end laptops and cell phones. That's it, right? So as EM gets wealthier, they're going to renegotiate and say, look, you just got to pay me a lot more to keep me interested in working horrible factory hours. So that is actually the dynamics that is going to shift for EM, right? So we're going to see EM corporate earnings come up, not because EM companies are more productive. They will be more productive, but it's because they can finally get a better margin, right? Instead of a 2% margin, they could go up to 4 to 6. And that's because productivity capacity is going to be much more value over the next 20 years than the past 20 years. And so it's really about this changing bargaining position that is the true story for the thesis for EM now.
That makes a lot of sense. I mean, especially with the examples that you just gave, the Amazon, the iPhone, and the small percentage of what they were actually making compared to what the revenue is for those companies there. There's this ongoing theme I'm hearing you mention more than once there about them negotiating for a pay raise and how detrimental that is to this whole EM discussion there. Let's talk a little bit about asset price appreciation. What types of assets do you see appreciating in the context of an aging global population? And how can pre-retirees safely incorporate these into their portfolios?
Yeah. And because the inflation this time is going to be driven by really a, shift in labor supply, right? Because a lot of people retire, right? Less labor supply, right? And so the inflation, right? You don't want to just think, inflation, I got to buy hard assets, right? Because sometimes inflation is reflected in just hard assets like, real estate and commodities going up. But sometimes it's the softer side, right? It's the human capital that's going up. That's what we're seeing in the US, which is it's actually more of the increase in wage rate than just commodities becoming pricier. So the way to hedge that is you got to go and own human capital, which is damn near impossible, right? You can't go pre-contract, 80 hours of someone's,
Time
in the future. It just doesn't work. There's no market for that, right? So the way to do that is, how do you buy human capital? How do you buy labor? Well, you got to go to manufacturing firms in emerging markets and you buy those firms because those firms have a way of tapping into that human capital and organizing them into production. So instead of thinking inflation, easy, I buy gold, I buy hard assets, that's not going to be enough. And it may actually not capture enough of the wage increase, right? Because this is not a hard asset driven inflation. This is not a monetary printing inflation. There's some of that for sure. There's going to be a tightness in labor market, labor wage stickiness inflation. And so hedge against that, you've got to go buy human capital. And the way to do that is you buy manufacturing powerhouses in emerging markets who really specialize in finding cheap labor, organizing them, and creating productivity out of that.
That's a really good way to explain that because, you started, that's what it pops into people's mind when you hear inflation. They think real estate, gold, commodities, these things that have, when we see inflation, but it's a reminder there that this human capital portion of it, and then the manufacturing and the production and trying to grab that and EM having access to it as part of the story for EM. So that's a good way to explain it. I haven't heard it explained that way. So I think that's a really good way to look at it there. Let's talk about wage inflation and retirement planning. How should pre-retirees prepare for the possibility of wage inflation impacting their savings and investment returns?
Yep. So, the wealth accumulation that we've seen for the pre-retirees, it does so well because the stock market has really just turbocharged wealth accumulation in their 401k. And then for those that are lucky enough to have some defined benefit, right, it means they're going to pay you out because they're flush with cash. So you're all good, right? All cylinder. But the risk is, okay, that's sort of nominal money coming in. But what if once you retire, things are really expensive, right? And so again, for pre-retirees, the way you want to position your portfolio is to understand the source of that inflation and hedge it off. And it's really two. So we've been repeating that in this podcast, right? Clearly the US will continue to print money, which means over time, US currency will weaken against, say, economies that don't have to print money. And again, printing money is more of an artifact of developed economies that simply the government's got too big over time with each election promising more goodies, right? Emerging markets don't have the same problem, right? They're big export, they earn a lot of dollars. The government, don't get into this sort of debt finance consumption just yet, right? They haven't got that point yet. So you're going to have relative strength there from money printing. And the other part, of course, is a big part of your inflation risk is, of course, U.S. wage escalating and running away. And I don't think the Fed is the solution, right? I don't think the Fed will go back to 12% to fight wage inflation because that's not going to work because the structural issue is we don't have people to work, right? You can hurt firms a lot, but that's not going to change the fact that we don't have the people to work. So the punishing higher rate is not the solution. The solution is for you to really buy firms that can access low cost but high quality human capital in emerging market. So I'd say, for investors, when you're looking at your portfolio, it's really time to shift away from anything that's just consumer oriented. That's about selling you more stuff to buy. You want to now shift toward industries, shift toward countries where they own a lot of the manufacturing capabilities, right? Historically, it's been distribution who capture all the margin. I think that's going to shift in a big time, right? So instead of thinking of digital platforms, the Amazons who made money by distributing what other people produce, I think that bargaining power is going to change and distribution will get a lot less and the manufacturing is going to get a lot more. So again, in the portfolio, a shift away from more the distribution, more the consumer sort of driven names into more of the manufacturer driven names.
I love it. I talk a lot with clients about what I call Act 2, right? So Act 1 is what we just mentioned when you talked about wealth accumulation and the 401k, if they've got it, if they're lucky enough to have a defined benefit there, that's done really well for them, but we're not done yet. So the idea of the inflation and then the idea of the dollar that you have now not being able to purchase as much as it was in the past. We talked about printing money. That not necessarily a problem for EM, but for countries like us, this is a thing. And then U.S. wage escalating, right? This really bringing on to our radar the idea of EM and countries that have manufacture and production, including that as a global portfolio, getting that onto your radar. We've got, just a few minutes here. We've got about 6 minutes before the end of the show. So I do want to make sure I'm asking some of these more long-term question. What's your long-term outlook for global economy, considering these demographic shifts that you talk about? How should that influence retirement planning?
Yeah. So, in terms of kind of my outlook, I am probably, I would say short run tactical, I still like the US because AI is, a credible solution to aging demographics, right? If we can have machines do a lot of the work, we may not need humans to do it. I think it's more of a FOMO, and I'm all for someone tactically riding that bubble a little bit because we know bubble can often run longer and bigger than you expect. But I don't think it's a complete solution in the sense that, look, AI mostly has replaced highly skilled programmers and creative artists, right? Like in terms of the service sector, right? Like we don't have a robot who's smart enough to wash my hair and cut my hair and wheel me in and out of the hospital, right? So I wouldn't get too excited about that, but I would say tactically the AI theme, at least applied to solving, shortage in labor could be interesting, right? I think where I'm most pessimistic is like Europe, right? They don't even have firms that are AI themed, right? Like they are aging. They don't have great solution. They're probably going to be held completely at bay by emerging markets. They print more money. It's a bigger basket case. So I would be a big underweight for broadly Europe. So in IFA, like the only thing I like is Japan, right? I mean, Japan is old. It's got all the same problem, but at least Japan has managed to not suffer the same inflation their issues that the U.S. and Europe has because their population saves so much money, right? Completely offsets, any inefficiency on the government sector. And with a super cheap yen going back to pick up their manufacturing capability to be competitive against other Asian economies, they have such a manufacturing culture. So I do like them. And of course, I'm repeating myself here to say, and of course, I love EM, right? I think it's a big secular bull market. And it's really this time is different type of structural shift. So those are kind of my long-term underweights would be kind of Japan and EM, both manufacturing powerhouses. US for that tactical reason, it's very expensive, but God, the FOMO can run longer and bigger than one imagined. And an obvious underweight is Europe for me in the asset allocation context.
I love it. Thank you for sharing that. A lot of really good information there. Talked a little bit about AI and, everybody's all excited about that. We talked about FOMO, fear of missing out on some of that and some of the things that it won't be able to replace, but there's a reason to be looking at that right now. So that's good to hear that. You talked about Japan. I mean, go and figure a country that incentivizes savings versus penalizes. To see that's actually a really good thing. And so that having that on your radar there is good. EM, of course, is one that we're going to be looking at. And then, Europe here is just an idea of underweighting. And so these are some ideas. I can see my compliance guy listening to the podcast and having a heart attack in the background. So I always got to remind people that, this is for educational purposes only. Definitely do your own due diligence. This is not to replace a financial professional. However, we're doing a big glossy look at some of these ideas here. And I appreciate you sharing this with us because this is really, really good information. As we close the show, we're right here at the end. Jason, what have I forgot to mention to listeners that you'd like to share with them today?
Well, I would say, do follow me on social media. I got out of social media and I realized how addictive it is to have people like what I publish, right? Like I shouldn't be of that age cohort, but it is addictive. Once you put stuff out on the internet, you feel like really insecure when no one reads it, no one likes it. So please, just for my ego's sake, follow me on social media, follow my research. I'm very easy to find on LinkedIn. Just put in my name, Jason Su, and you can subscribe to my newsletter, The Bridge. And ping me through LinkedIn chat group and I will be responsive and hopefully helpful as well.
Absolutely. So I've been following the newsletter since I've subscribed. Great information. Listeners, definitely encourage them to reach out and subscribe. And then to find out more about Reliant, what is the website for people to find out about Reliant?
Yeah. So www.rayliant.com. And for the range of funds product we have, it's funds.rayliant.com.
Perfect. Okay. And if you're driving, don't worry. I'll have that in the podcast notes. So Jason, thank you so much for joining us today. Have a great rest of the afternoon there.
All right. Thanks, Chris. And thanks, everyone.